What's going on, everybody? It's Blake Ragland here, Bradshaw and Will. I'm here with Brandon, our financial planner, once again. And last time we talked about the potential retirement danger zone and the risks that can go before retirement and after retirement. So today we're actually going to talk about another risk called sequence of return risk. So Brandon, what exactly is sequence of return risk? Can you explain it a little bit for our viewers?
Okay, thanks, Blake. Yeah, we did talk about the potential danger zone, and one of the big risks in this potential danger zone is the sequence of return risk. And this risk is just simply the risk that right after you retire, you're no longer receiving a regular paycheck. When you start drawing money from your retirement account, if in those same early years you're also having investment losses, this double negative can have a real decimating effect on your entire portfolio.
Okay, well, let's break it down a little bit more. Let's start with this accumulation phase here in before your retirement.
Right.
So kind of tell us why the sequence of return isn't as decimating in this accumulation phase.
Okay. So first off, we're going to look over here just at the accumulation phase. And we're going to start off with $100,000. We have two different returns. They're exactly the same except inverse of each other. So the 33 here is 33 here, negative 22 there is here. And if you look at it early on, the 33 here, you end up with 133,000 versus over there, 78,000. After year two, boy, it's a huge difference, isn't it? 170 to 68,000.
Right.
But over time, at the very end, we end up with exactly the same amount of money, 128,667. So over here, we're not taking money out of this account. So what we're saying is the order of returns did not matter. If you had the exact same returns, then at the end, you end up with the exact same amount of money. Does that make sense?
Yeah, so you're saying when you say the exact same return, so you're saying like we're averaging X here and we're also averaging X here.
Well, what I'm saying is you see the 33, 33. It's more, they have the same average, but you also have exactly the same number, 33, 33,
right.
22, negative 22. So those are
Okay.
exactly the same. Now over here, if we average this up, and divide it out, that actually equals out to a 6.5% return, okay? So a lot of fluctuation in there, but if you do the math on that, that averages a 6.5% return.
Okay.
So now let's take a view over here of what would happen once we retire and start drawing from our account. So this is what we'd call the distribution phase. And so we have our $100,000, and if we get 6.5% return on our investment on average, so 6.5 of $100,000. That's not writing very good. You may have trouble seeing out there, but that's $6,500.
Okay.
So what we're going to do in the distribution phase is take that out every year, okay?
Yep, I'm with you.
We have the same returns over here in distribution phase as we had over there in this example.
Okay.
So you look at them the same.
So the positives are first on this side
Right.
and the negatives are first on that
Exactly,
side. Okay.
exactly.
Okay.
So when you get down here to year 4, look how much difference you have here. It's a huge difference, right?
Right. So year 4 with the positive returns first, we have 158,000 approximately, and with the negatives first, we have 47,000. That's a huge difference.
Right. And then at the very bottom, so at the end of this, we end up with 97,374 here versus 66,160 on the other side. So you had a difference. Now over here, when we had the exact returns in inverse order, we ended up with the same amount. Over here, we didn't. That's when we started taking that 6,500 out each year.
Okay. So why is it that it's like you have the same returns, but you're getting different ending points here?
Because once you start taking withdrawals, if you have negative returns early on,
okay,
that is what we call the sequence of return risk, and that is really deadly for your portfolio.
Okay. So we're taking $6,500 out every single year, but with these negative years early on, that's really hurting us because we're taking money out while the market's down, is what you're saying. Okay.
Exactly.
Okay. Well, how do we help avoid this? Like, what are some ways that we can prevent this from happening? Because that's a huge amount. That's $30,000 right there.
And this is 6 years. A lot of people may live 20, 30 years in retirement. So you keep doing this over a long period of time.
That can deplete really quickly.
You could deplete or really run it low. So here's the takeaway. That's a great question. Unfortunately, we have no control over the stock market return, right, when you retire. Mm-hmm. So that's going to just be random up and down. Probably about 70% of the time it's going to be up, but it's random.
Right.
So what your takeaway or the retiree's takeaway is, once you retire, you want to have some money in your emergency account and in some accounts that fluctuate very little or not at all. So if you start out and you have a negative 22%, instead of drawing from an investment account while it's down, you can pull somewhere else.
Right.
That's the key. Have some money that you can pull from that's not going down at the same time. Does that make sense?
Yeah, that makes perfect sense.
And so there are different vehicles out there that could do it. Emergency fund typically would be like in a bank account where you have access to it with no fluctuation.
Right.
Other money, a lot of times where you're going to use for a little bit longer period of time where you don't want it to move up and down. Indexed annuity is a product. So there's different products out there, but what you're wanting to really emphasize is you have money that you can draw out early on that's not subject to that market risk.
Okay. Well, is there anything else you want to add before we shut down here?
Well, so if we look at our next video, here's something to kind of think about. Over here, we took out 6.5%, right?
Right.
6,500, and we had the positive returns first, yet we ended up with a little less than what we started with.
Okay.
And you'd say, why is that? And that's going to lead us into our next video about volatility and how that can have a negative impact on your portfolio also. So next time we'll look at that.
Okay, awesome. Well, thanks for tuning in, guys. Like Brandon said, next video we're going to be doing is on volatility. So tune into that one for some great information. Thanks.